It must be the evidence to be the reader that have no enthusiasm for common stocks at the level 892. The reason for already given we feel that the defensive investor cannot afford to be without appreciable portion of common stocks in portfolio, even if we regarded them as a lesser of two evils. A greater being exists in risk of all bond holding. The commentary nickel won't worth a dime anymore. Yo Himera. For an investor, inflation is an event. It is normal. It was easy to forget over the long period from 2009 to 2022 when the cost of living at least as many government measured it barely budget. Money illusion. Investors tend to overreact to high inflation on a short run while underrating the lower inflation in the long run. Most of us suffer from the fundamental misprescription of psychology called money illusion. Imagine three pieces Amelia, Bella, and Charlotte. At different times, each inherits 5 million and spent at all to buy house, then sold the house 1 year later. During this, Amelia owned her house and server deflation reduced the cost by 25% at the end of the year. She sold the house for 385, that 23% less than she paid. During the year of Bella owned her house and cost of living doesn't change. There were no inflation deflation. At the end of the year, she sold the house for 95 or 1% less than she paid for it. During the year, Charlotte owned a house, inflation on 25% at the end. Yeah, she sold the house for 6 or 50 lakhs more than she paid. Who made the best deal? Who made the worst deal? Salvage is most people will say Charlotte made the best deal because owned the best. Nah, yet Amila did the best of all three. She has the only one who came out ahead after changes in the cost of living. The good service between cost 25% cheaper, but she sold the house only 23% less than it. The cost living 200 better off. Adjustment of the changing cost taking place extra mental effort. Thereafter, the nominal price unadjusted for inflation is obvious, simple, and silent. Yeah, to ignore how much bigger 1 million, 6 million, $15,000, $650,000 than $500,000. Only if you stop to think about or a grasp of a calculator, will you realize that Charlotte would have been sold the house for 620,000 as a break even after inflation? Likewise, investors tend to forget the commonly cited investment returns. This is not adjusted to inflation. Assuming that the cost of living was tend to rise at least 3% year at long term, you would get the habit of subtracting 3% annual from your expected return. Someone who projected the stocks will rise an average of 5% annually, really saying you should expect more than 7% per annum net inflation. To be the intelligent investor, you must counteract the money illusion. Keep your expectation realistic by always subtracting the plausible inflation rate from the projected return. But the inflation never is the trick for intelligent investors to defend against it without overreacting to it. Hedges or hedges. Which financial asset provides the best protection against inflation? When inflation flares up, scary rhetoric can bind you to faulty logic. So be sure to base your decision on statistics rather than stories. You are an egg. As you consider defending against inflation, sort your asset into three mental buckets. Capital bucket consists of cash, bonds, stock, publicly traded real estate, commodities, and other marketable assets. Some shield better than other against the rising cost of living. To protect you from the inflation, financial capital should be liquid. And financial capital can be quickly and easily converted into cash. Human capital is the present value of all the income that you that the job, that your career, the education will produce by giving back to the school or another degree, studying for a professional certificate, acquiring proficiency in vital new skills, moonlighting in the part-time job, as starting your own business. You can augment your human capital and push the growth into your total income well past the rate of inflation. Don't invest too much in your financial capital in some industries where human capital is concentrated, where you take care, don't you are taking care not to put all your eggs in one basket. Remember to count yourself among the eggs. Physical capital is a materialistic possession, your home, your car, your farmland, your timberland, and the fine collections like art, antiques, wines, jewelries, coins, stamps. Over decades and even centuries, some physical real estates have tended to hold their value during the inflation period, and particularly if they are high quality, they don't generate income. So don't forget to consider your human and physical capital when you hedge inflation. Otherwise, the investment industry propaganda machine will your fixation all your attention on your financial capital. That way, you will scared into buying funds tailored to looking good and generate high fees and high fees. You're scared of buying fund tailored to looking good and generate a high fees when inflation heats up. Many such funds aren't liquid or doesn't generate income, limiting their usefulness of inflation fighters. The financial advice and other investment markets rarely remind clients of basic facts and Graham emphasis. An inflation hedging asset should earn consistently higher return as the cost of living rises. By definition, that should earn consistently lower return as the rate of inflation. Assets that does well when inflation is hot, and what is not would be an investment paradise. It also impossibility of Wall Street is not a Shangri-La. Insurance isn't free. Insure against inflation. You must pay a price just as you do to cover your car, your home, your life. Here is the main way to insure against inflation. Each comes at a cost. Gold has served as a store of value for remarkable long time. The same quality of gold of Roman centurion owned annually when European Augustine 27 AD to 14 27 BC to AD 14 would still have covered 1 year pay for US Army captain more than 2000 years later. However, the 1900 2000 gold owns an average return least than 0.8% annually after inflation, only slightly better than cash. Had your investment as $1,000 in gold on January 19, you have finished 2022 to 2500 compared to roughly 7,800 US bonds and morely 2 million stocks would put the same in thousand in cash each. Along the way, the price of gold swung up the down, almost eradicated stocks did and often lagged inflation instead of uh, beating 2001. As the cost of living surged, the gold fell 3.5% in 2000 and the inflation breaks out. The modern records of precision metal lost to 0.4 percentage in 2003. Inflation fell, gold rose 13 percentage. It is very long run. Gold had been a good way to sustain purchasing power in the shorter run. It is unbelievable made the hedge against inflation. I bond first a serving bond issued by the U.S. government whose interest rate adjusted twice a year to track the official rise of consumer prices. They are essentially risk-free. The U.S. Treasury guarantees to pay your original money back plus any inflation that's occurred actually. This means your bond will preserve their purchasing power for up to 30 years, no matter how much damage inflation does. They will not grow above the rate of inflation, though. I bond is also a tax advantages. However, you cannot easily invest more than $10,000 per year. They are available exclusive for Treasury direct government, but you aren't likely to be able to buy them unless you are US citizens or resident. You can sell I bond at all the first year, and you are forfeit 3 months interest if you sell within the first 5 years. While they offer excellent protection against inflation, I bonds are imperfectly liquid and are hardly to buy in bulk. Inflation linked bonds. are all helped cushions rising cost of living, called treasure inflation percentage protection security tips in US. Linkers are issued by many other governments like Europe, Asia, Latin America, elsewhere. Some bonds automatically adjust their principal and amount. Some bond automatically adjust against principal. The amount that the issuer will repay you as a maturity date is the inflation rises and falls. Unfortunately, inflation-linked bonds can be overpriced and hypersensitive to changes in interest rate. 2022 U.S. TIPS lost 11% on longer-term TIPS and matured 30 years fell below 40%. Now it is 2024, though the long-term US tips offer investors the opportunity to lock in the guaranteed return at least 22% annually. After inflation, the next 30 years, while the modest rate of growth above the rising cost of living, it is a price like ultra-safe high-term insurance policy. If you are approaching retirement, if you are approaching retirement, your wages or income will seize the value of human capital with a dwindle inflation protection bonds an ideal way to guarantee financial capital will survive in case of cost of living at your age. The real estate is a shelter, although it might not shelter you from inflation as well as a thing. Between 1980 to 2014, the average growth rate US home prices is 0.3% and naturally affected inflation, according to the Yale University economist Robert Schiller. Our house is a home, not a hedge. And commercial real estate is also sensitive to rise interest rate. That is only a partial protection against inflation. Stocks is do fine when the cost of living rise moderately up to 4% annually. However, once inflation hits a double-digit asset to the US around the end of the World War One and Two, the late 1970s, the stock performed abysmally, which are real losses average more than 7% annually. The same has been true worldwide more than a century. The stock earning an average real return of less than 1% annually. The inflation exceeds 7.5% annually. An average real loss of nearly 10 percentage of annual when the cost of living rises in the high double digit. Certainly does not mean you should avoid stock. An asset doesn't have to perform well all the time to perform well over time. When the rate of inflation moves up quickly and significantly, stock will incur severe losses that you take years to recover from. Over long periods, however, stock has historically far outpaced the risk of consumer prices. All the certain short-term declines in the market value of stocks during the inflation spikes are one price you must pay to capture the higher, longest term returns. Changes in the cost of living. Mm, Certainly does not mean you should avoid stock. As asset doesn't have to be performed well all the time of performing well over time. When the rate of inflation moves up quickly, significantly, stocks will incur severe losses that takes a years to recover from over a long period. However, stocks have historically far outpaced the rise of consumer prices. All but certain short-term declines in the market value of the stocks doesn't during the inflation spike is one price you must pay to capture the higher longer-term return. Changes in cost of livings vary across time and nation. So many sense to keep a substantial portion of your stock portfolio in companies whose shares are listed in market outside the home country that can provide a source of return for assets during the value or in being eroded or forced by inflation. Bitcoin often been tuned in recent years sort of digital termination that pulverize inflation. The batch because supply of Bitcoin is limited to 21 million units after the last of this creator, no more will Bitcoin exist, which would means that Bitcoin value can't be diluted, but too much is issuance. Value can't be diluted by too much issuance. By contrast, supply contravention, government issued currencies is potentially unlimited, degraded the value over time, and fueled a large by such Retrotic Bitcoin gained 94% in 2019, 318 in 2020, 57% in 2021, and according to Bitcoin Bitwise Asset Management. Now, the Bitcoin doesn't even begin trading publicly until July 2020. You can't draw sweep conclusion from the return over such short history, especially because inflation was low over most of the period. In 2022, inflation racked and Bitcoin fell far worse than most of the asset crashed by almost two-thirds. The exact time when inflation investors most urgent needed protection for the inflation, Bitcoin deflated. 2023, as inflation fell, Bitcoin showed more than 156 against more than the inflation hedge would be. Would Bitcoin continue to provide an high return? And that's anybody guess a superior cryptocurrency might arise later and making a Bitcoin obsolete. Although this seems unlikely, the software updates might introduce crucial flaws and undermining confidence. Central banks will introduce their own digital currencies, marginalizing Bitcoin over a price might go into the protracted decline that feed on itself, making Bitcoin network less attractive. Rather than thinking of Bitcoin purely as a money, consider it a scarce collectible that can also function as currency like gold. Possession such a rare object gives a collection pride and pleasure, even its object is no longer remains fashionable. The suggestion that Bitcoin may retain some value even if they never becomes fully acceptable as currency. How much might end up being worth? The Bitcoin might turn out to be a stable store of value measured over centuries as gold, as or it might resemble a rare artwork. These values tend to rise over time, but the extreme inflation, the extreme fluctuation along the way of Bitcoin might turn out almost an ephemeral or beanie babies, or a cabbage patch kids, or a pet rockets. Prices peaked in the wild phase decades ago have never recovered. Warren Buffett has joked that if we were to teach a class of valuing stock, he would ask the final exam how much speculative internet company was worth. And anybody that gave me an answer, he whipped. I would flunk. By the same token, Bitcoin would someday end in worth $1 million or more, or next to nothing. The gamble just might pay off, but giving Bitcoin short history and while warrant, violate this effectiveness as inflation hedge remain unproven. Commodities as a more popular but imperfect hedge. Leading commodities funds generate 20%, 30% more than 200. Handling beetling rise to consumer prices. However, return on investment commodities vary widely over time. Gold gained 161 in 22 and lost 48 in 22. 21 and 48% 22 and another 10% 23. Lithium lost 55% to 19 and fell another 30% to 20 and gained as donation as 443% to 21, another 72% in 22 and 23 it fell ghastly 81 percentage. The popularity of recent years many have distorted the market in commodities, undermining their ability to combat future inflation. Over a long run, $1 invested in US stock in 1989 97 would grow to 1,869 by the end of 2022. Then the commodity would have grown only 7,444 per dollars. In short, no single asset can fully protect against the rising cost of living, but supplementing stock portfolio with a big sludge of inflation protected bonds can you build your financial into the strongest bulwark, and your human capabilities and physical capital would bolster you too.